Good evening, everyone. How are you? And thank you for joining us today for the Investing Bootcamp webinar by Sarwa. My name is Eamon Gebre, Head of Wealth Advisor here at Sarwa, and I'm joined by my lovely colleague and co-host, Ms. Daryl Hulse. Thank you for joining us today. What's the date today? We are on the 19th, so it's still early enough we can say happy belated New Year's, right? It's not
as long as
wrong to say
January.
that, right?
Yeah, I think
it's still January, so right up until the 31st. Happy New Year's to you. So you'll start seeing that in my emails going out. Any New Year's resolutions for this year?
So actually, I had this question posed by another member of the Sarwa team, maybe marketing. They're probably doing some content around it. But for me, I definitely want to focus on having less screen time. I think the majority of us all spend 90% of our time at work in front of laptops. And then in the evening, we're guilty of being on the phone or other devices. So I'm making an active effort to be more present, whether that's with my family and, cook or whatever it is we're doing, rather than having the phone close by. So we'd switch off now, turn off the data, 6 p.m. or whenever you finish for the day, and then phones down.
No, that's definitely aspirational. Mine is a little more related to health and wellness, like specifically like getting off the couch and going to the gym or doing some sort of physical exercise. I don't want to call it a New Year's resolution. I just want to call it, goals, right, for 2022. I mean, same, different, I guess. But exactly, Aiming 2.0. So a colleague of mine invited me out for a walk yesterday evening, and I said, hey, why not? It's a walk, good opportunity to catch up. I didn't realize this walk was going to turn into a race. And it turned out to be an 8-kilometer race around the Marina Walk. And I'm still sore till today. And we started off with a nice casual walk, and the pace just kept on picking up. And at a certain point in time, we were just huffing and puffing, speed walking through Marina Walk. But I can tell you what, I enjoyed it. I loved it. I feel a little bit sore today. And we walked, 8 kilometers. I thought that was an accomplishment. It was a great way to start off the year. But yes, trying to get fit. Spectacular. And speaking of aspirations, thank you to everyone who's joined us today for our Investing Bootcamp webinar. You've obviously taken the time and prioritized your financial literacy to understand what the best practices are when it comes to investing. So we are going to dive right into that. There are 4 specific rules that we identified would be very beneficial for you to put into practice to your everyday investment decisions. Again, my name is Eamon Gebre, Head of Wealth Advisory. We're joined by my colleague, Daryl Hulse, for those who just signed on right now. And we're going to take you through this journey, and I encourage you to ask questions. We will be taking them up towards the end of the presentation, but don't hesitate to send it in the meantime. We actually have a moderator. If they have the answer available, they'll be able to answer to you directly right on the spot. If not, we'll be addressing them towards the end of the
definitely do it along the way, because otherwise, you get to the end and you forget, and we move through quite a few different subjects. So just pop them into the Q&A section rather than the chat. Q&A at the forefront of the mind.
Spectacular. On that note, shall we start, Daryl?
Absolutely. Let's go.
Spectacular. So look, it goes without saying, it's one of those things that's a disclaimer that we need to highlight. We don't have a crystal ball. We cannot predict the future. There is no point even trying to guess, because things can change rather quickly. I think the last few years have kind of shown us that, in which things can come out of the left field. So we don't have a crystal ball. We can't tell you what's going to happen in the near term with any specific stock or ETF or et cetera. And on top of that, the conversation we're having today is really more about best practices and how you can make it work for you. It should not be interpreted as one-on-one financial advice. To receive one-on-one financial advice, either reach out to your financial advisor or reach out to one of ours, and be more than happy to listen to you to understand your goals, objectives, and we'll be able to give you a recommendation as to how best to achieve them. Okay. Spectacular. Now, for those who are already existing Starwood client users, you'll understand that, one of our, one of the goals that we try to achieve here is we want to democratize investing. We want to make things very transparent. We want to make it very cost effective. We want to make sure we educate our clients throughout that journey, because we want to make them better investors. The better investor you are, the more successful you will be down the road. And unfortunately, within this region, that tends to be quite difficult, or a little bit of a challenge, or there are too many barriers. when it comes to learning about investing or access to tools and resources, or even solutions that are cost, efficient or, doesn't have a really high minimums. And as a result, unfortunately, it's not a surprise that majority of individuals within the UAE actually do not have any long-term savings. It's not to say that they don't have liquid savings, as in cash put aside in a savings account, but they actually don't have their money working as hard as possible for them. And this was validated in 2020 by consultancy Mercer, that showed that 61% of the people in the UAE surveyed have no long-term savings plan at all. Now, the challenge with that is having money sitting idle, sitting aside in a savings account or in a current account in many cases, is that the purchasing power of your money diminishes over time due to a little thing called inflation. You may not see it, you may not be able to touch it, but it is real. And I would argue to say that over the last few months, you probably have recognized or felt that pinch on the bottom line. Groceries are costing more. Try purchasing a vehicle anytime. Now it's costing a lot more than it would a year ago for during that period of time, or 2 years ago, due to all the shipping delays that are happening all around the world. Basic day-to-day goods are costing a lot more. So what you want to do is you want to try your best to beat inflation, which is estimated to be anywhere between 2 to 3% per year. What you can do to try to combat the impact of inflation is to try to make your money work as hard as possible for you by putting it to work through investing. And when I say investing, there's a lot of different terms, a lot of different ways you can invest. Some individuals love investing in real estate. They like buying, assets like that, letting it appreciate over value, or maybe they might flip properties to generate X. Or some may purchase land, some may invest in businesses, some may decide to buy and sell stocks themselves, or some may go to a wealth management firm to give them advice on how to grow their wealth. The point is, at some point in time, you got to make your money work harder for you by putting it to action, right? But you need to make sure your foundation is in place, because unfortunately, similar to building a house, if you don't have your foundation in order, you could potentially risk having it all crumble down if you don't have it, in a very solidified status before you start. And one of the things that we recommend to many, if not all of our clients, is having an emergency reserve set aside. I can't stress the importance of this. And we saw real life cases, especially in 2020, with individuals who were very heavily invested, whether it be in real estate or in capital markets, but didn't have liquidity set aside. And unfortunately, due to the interruption, whether it be business interruption or, job interruption or whatever it might be during 2020 lockdowns that we experienced, several months later, individuals started losing their jobs, but they didn't have the liquidity to help them get by. So they ended up liquidating some of their investments, if it was even able to be liquidated. And the markets weren't exactly doing that great at that point in time. So it's like adding salt to the wounds. You don't want to put yourself in a position where you're just depending on your investments to help you get by. It's important to have an emergency reserve set aside. And we recommend anywhere between 3 to 6 months worth of living expenses set aside in a savings account or in a current account that you have access to quite easily. Now, the next bit would be as far as debt management. This is key, especially in an environment that we're in today, where interest rates are expected to go up. You do want to prioritize this. You don't want to have debt hanging over your head and eating into your net worth. Imagine you're paying 36% per annum on a typical credit card here within this region, and you're indebted, and you're carrying forward that balance month after month. And by the end of that year, you're paying 36%. Plus compounding, it could be quite a hefty charge that you're incurring. Whereas if you're trying to invest and you're, maybe earning your 7 to 8%, which you're really happy with, but net, you're actually quite negative. So the whole idea is to try to prioritize your debt as quickly as possible, especially if it's unsecured debt like personal loans, vehicle loans, overdraft protection. Secured loans such as mortgages, there's an asset that's tied to it, and of course it's important to prioritize it, but I would say more as a secondary concern than it is as a primary concern. And there's a lot more solutions available through your bank or other banks to try to find ways to reduce your total cost of borrowing when it comes to mortgages.
If you don't mind, to add to that point, because a common question that we get asked, as I'm sure you do as well, is whether clients can fund their Sarwa portfolio or maybe other providers through credit cards. So currently we don't offer this service, although it may be something we introduce later on, but I just wanted to take the opportunity to highlight the reason why we don't offer this service right now, which is, to your point of being net, it depends on the credit card charges that you're incurring and whether you are likely to pay that off month to month, because if you're crediting your account with Sarwa or anyone else with a credit card and then you're not paying that off immediately, it's just completely counterintuitive. It doesn't make sense. What you're paying in interest on your credit card is just eroding what you're earning in your investment portfolio.
Absolutely, absolutely. And in some cases, these credit cards will treat that transaction as a cash advance, which is much more expensive, and you don't even have that grace period of paying off your balance in full within a certain timeline, interest-free. So it's really important to kind of look at the terms and conditions of the credit card provider, just to ensure that you don't get stuck on that debt trap. And then the last piece of the foundation is just establishing good savings habits, right? It's great that you might be really inspired and you want to start investing, but it's important to kind of have a disciplined approach to investing. And one of the things that we would recommend is making a budget and following this guideline, which is the 50-30-20 rule. 50-30-20 simply states that try to limit your expenses, your fixed expenses to start with, to be no greater than 50% of your gross monthly income. This is your housing, education, groceries, health, transport, etc. Try to limit this to be no greater than 50% of your gross income. Then you move on to your wants, your discretionary expenses. This is where we're talking about entertainment, clothes shopping, Netflix, which is, we saw the rates are going up for Netflix, by the way, in the US and or North America altogether. So we'll see how that impacts us in the rest of the world. But it could be even subscriptions that you have, holidays, etc. Try to limit this to be no greater than 30% of your gross monthly income. That remaining 20%, assuming that you have your debt under control, you have your emergency reserve set aside, that's that sweet spot, that 20% that you can apply towards your long-term savings goals. And you'll be quite surprised as to how quickly it adds up. A diligent process of saving on a monthly basis goes a long way in comparison to sporadic investing every now and then. Now, this is really more foundational, right? I mean, let's jump into rule number one, or best practice number one when it comes to investing. And this is where the core principles of what we're going to talk about starts here, is the importance of starting today. Not tomorrow, not the day after tomorrow, start now. But why is that? Well, there's a little thing that we might have learned in high school or possibly even primary school where, our teacher may have talked about compound interest. It might have been just like one unit, maybe within math class, if anything else, but comes back again full circle because it's such an important and integral part of financial planning. Compound interest is the eighth wonder of the world. Albert Einstein even talked about it. Why is that? Well, let's look at the power of compound interest, right? And to kind of illustrate this point, let's take an example where you have an investment solution, recommended to you, and you have two options. One of those options is to have the interest paid out year after year on the anniversary. So you invest $10,000, January 1st, 2022, January 1st, 2023, you have your interest paid out to you, okay? Or scenario number two, or option two for that matter, is that instead of having that return paid out to you, you could actually have it reinvested back into your portfolio. It's like, oh, okay, interesting. So, we see different types of investment solutions within the region, some of which fall under column A and some fall under column B. But let's look at the impact. So should you choose column A or solution A, in which you have the dividends or interest for that matter, and this is a simple example, paid out at 5% per annum. And suppose you invested $10,000, you'd have $500 paid out to you in year one. You repeat for year two, you'd have $500 paid out to you in year two, and so forth and so forth. For the next 30 years, you've been earning $500 from your investment on an annual basis, which is amazing because people think about passive income. Hey, I'm earning $500 per month. This will help subsidize my expenses on a day-to-day basis. I'm winning. It's a spectacular investment move. It is, for those who need income at that point in time, that could be a great solution for you. But let's look at the alternative. Solution B, option B, column B, et cetera, et cetera. What if you just took those returns and reinvested them back into the principal year after year? Meaning that year one, you had $500 paid out, but you decided to reinvest $500 back into your investment plan. So in year two, you had $10,500 to start with. And in year two, you earned 5% on $10,500, and you continued down this path on an ongoing basis. Well, believe it or not, with the same timeline, 30 years, you would have accrued $30,000 in compound interest just by reinvesting dividends or reinvesting the returns on an annual basis, just simply due to something called compound interest, which is really powerful. In comparison to column A or the solution A, as I stated, you're having a payout of $500 per annum, multiply that by 30 years, that's $15,000. So you're looking about double. The difference is about twice as much. So it's quite important, or kind of integral. But to kind of illustrate a little bit further as far as the importance of starting early and how compound interest makes a big difference is, we have two colleagues, Gina and Rena, office colleagues. They, were having a discussion at the water cooler, and they both agreed on putting a plan in place towards their retirement goals. Now, Rena is slightly older than Gina. Rena is 35 years old, and she's highlighted that by age 65, I would like to retire. I no longer want to work. I want the option of not having to work. And Gina also agreed with her, saying, look, I really like that idea. I also want to stop working at age 65. And I want to put a plan in place, a contribution in place to help me get to that target. Well, they both agreed on putting $5,000 a year away into an investment plan. And simple math, just on principal contribution, you're looking at Rena put away $150,000. That's 30 years multiplied by $5,000. And Gina, who has 40-year investment horizon, has put away $200,000 in principal. So just a 10-year gap between the two. From a principal perspective, it's not really that much of a difference. It's only $50,000. If you're looking at the statements, they look almost the same. It's not that big of a deal. But guess what? Gina's younger. Gina's 10 years younger than Rena. So she's been investing for 10 years longer. Well, let's look at what the impact would be based on these variables that we just talked about. Rena managed to accumulate in total portfolio growth. And again, there's an assumption here that there's a 7% annual return. She managed to grow her portfolio from $150,000 to $508,325 during that period of time. She's really happy. She's got herself a nice little nest egg that she can enjoy her retirement. Whereas Gina, same variables, except she's been investing for 10 years longer. She had $50,000 more in contribution. That $200,000 that she invested in principal turned into $1,093,681. Simply because, not because she invested more, not because she had a better return, they had the exact same return, but simply because she started investing sooner. And that's the importance of starting as soon as possible, because time is on your side, but you need to take advantage of it, okay? Daryl and I have conversations on a regular basis with clients who might be a little bit apprehensive about the current state of the markets, right? They're reading the news and they're seeing everything in red, and one day it's positive, one day it's negative, and they're thinking that maybe they should just wait on the sidelines for a little bit, let things calm down for a bit. And once there's a clear direction in the markets, then they'll decide to enter. The challenge with that, ethos, with that idea is that it doesn't work. And studies have shown time and time again, trying to time the market hardly ever works. In fact, an individual who does not pay attention to the short-term noise and just invests and takes a very patient view towards their investment and thinks long-term tends to be rewarded. And to kind of highlight this, I want to show you the S&P 500 price level, all the way from 1927 till 2017. And it kind of highlights key moments, within the world, whether it be natural disasters, political, situations, wars, etc., and how the stock market behaved during that period of time. And you're going to notice a lot of ups and downs. I mean, we look at the Wall Street crash that happened, in the late 20s, and we've seen the market drop significantly during that period of time, upwards of maybe close to 60 to 70% in some cases. We saw the market rebound through the Great Depression. We had World War II. We had the Korean War. We had the Cuban Missile Crisis. We had the Vietnam War. We had the US economic recession in the 1980s. We had the Gulf War. For those of you who've been in the region during that period of time, remember it to be a very scary moment and had an impact on the global landscape. We had the dot-com bubble in the year 2000. Ups and downs. We saw the S&P 500 go through all these ups and downs, but you'll notice that there's a trend here, and it's kind of jumping right out at you. Markets generally appreciate over the long term. It just takes patience and holding on, going through that difficult moment should one happen during that period of time. And it's just a matter of just having a long-term view and riding out that little bit of a roller coaster wave so that you can get your reward. And that reward at the end of the day is a better performance on your portfolio.
I mean, I know
Now,
that this chart that you're demonstrating here is a little bit out of date now, but I mean, the principle remains true today, whether it's, we add on the coronavirus or anything else of more recent times. And I think this is such a great example because people say to us, is now a good time to invest? It seems like it's a bit uncertain. I'd rather wait until things have calmed down and then I'll feel more comfortable getting into the markets. Particularly recently, markets have been fluctuating between similar levels. We've seen a bit of a drop off in global equity markets back end of last year through Q4. So again, we're getting these kinds of questions. Is now the best time to invest? Should I wait? Niall, the example that you give, well, the many examples, but the one to highlight is, for me, the Cuban Missile Crisis. I mean, here, it was one of the most uncertain times that the world ever went through. I mean, we were on the brink of a nuclear world war. So, I mean, it doesn't get more uncertain than this. And yes, we've just been through a global pandemic, but that's not the first one that the world experienced. There's been many in the past as well. And if we look now at that time, mid-1960s, that most uncertain time had such a minor effect in the overall trend. So the times are no different today. The exact same underlying principles apply. So as the saying goes, the best time to invest was yesterday, the next best time to invest today.
Absolutely. Thank you for hammering that home there, Daryl. And as a good, recap for this section, best practice number one, be decisive, take action. And what that really means is just assessing, making sure your house is in order, have your foundations in place, have your emergency reserve set aside, prioritize your debt. And if you don't have any, then you could stand, to start investing towards your long-term goals and start today, even, whatever your capacity may be. I mean, you have companies like Sarwa, which allow you to invest for as little as $5, right? So you don't need to have a large lump sum to start investing. So it's up to your capacity to start investing. And the whole idea is to start sooner than later. Now, of course, planning and taking action, and is great and whatnot, but you also likely to ask yourself, okay, great, where do I start? What do I do, right? Where do I go? What should I be investing in? Our advice would be in that situation is to take a diversified approach towards your investment, right? It's a whole idea, and you've heard this time and time again, as far as, don't put all of your eggs in one basket. Well, let's talk about what that really means and what the benefits are, right? Well, it's important to kind of give credit where credit is due. So Harry Markowitz, Nobel Prize winner, basically coined the term diversification. He is the father of this theory altogether, and he's done such a spectacular job because this is universally practiced amongst wealth management institutions all throughout the world, from private banking all the way down to retail banking altogether. And this is the basis of financial planning and wealth management, where you take a diversified approach. Now, what does that mean, right? Well, I present to you this very lovely chart that may have looked like my daughter put it together, but it actually is very important to kind of drill down and take a look at. This highlights the different asset classes between 2016 and 2020 and how they performed. So when I point out, to the top left-hand side in that baby blue color, that's talking about small cap stocks, right? If we're talking towards the bottom of the same year, 2016, that says cash. And top of 2017, that's emerging market equities, right? So what this chart is trying to highlight to you that every single year, asset classes that may have performed. Okay, let me repeat this again. Every single year, there's a different asset class at the top of the list as far as best performing asset class. So in 2016, small cap stocks did the best in comparison to all other asset classes that are available for investors. And towards the bottom, if you were an individual that was sitting in cash, you did not succeed, or you did not perform as well, because cash was quite negligible that year. The returns on cash were around 0.3%, so not that great. However, in 2017, some may assume that, well, 2016 was a really good year for small cap. I'm going to put it all on small cap in the following year. But the reality is, asset classes change. There are cycles. There's so many external variables that determine what will be the best performing asset and what will be the worst performing asset. And in 2017, emerging markets was top of the pile or top of the list at a return of 37.6%. Towards the bottom, interestingly enough, and not surprisingly, was cash. But 2018, there was quite a bit of market volatility then. And interestingly enough, if you were sitting in cash in 2018, just coincidentally, keyword coincidentally, you would have been, top dog for that year because you didn't have any losses. Because had you been in the markets during that year, for example, in emerging markets, you would have been negative 14.3% to be exact. And if you were invested in large cap companies that you and I know very well, probably wearing or using some of their brands as we speak right now, large cap, that had a return of 4.4%. The point of this chart is to illustrate to you that you are not, it is very difficult to be able to choose a winning asset class or a winning market, winning sector, or winning geographic, zone that has the best returns because it changes on an ongoing basis. And for you to be able to try to invest in each and every one of these asset classes would likely take you hours, if not, maybe weeks or months to be able to manage. Or to even just to get to the point of choosing. Secondly, it likely cost you a lot of money because if you're trying to buy stocks within this one sector and another sector and that other sector, how much bandwidth do you have to be able to buy all these different asset classes? There are thousands of different stocks that you can buy. And Daryl, I think you look like you wanted to mention something, and then I kept jumping in. Do you have anything you wanted to add?
I was just going to say, just to simplify this slide very easily, if we just focus on that top line, I know that it looks a little bit like a roulette chart, but just focus on the top line, you can see that the top performing asset class changes every year. So to be consistent with a top performer is near impossible. You might get lucky once, like Eamon says, with emerging markets in 2017 and think, great, I'm the best stock picker ever. But actually, in reality, we're not, and 99% of us are not top stock pickers, let's be honest, even that's the work in the industry. So to get it done once is probably a bit of luck. To do it every year, then come work for Sarwa, in all honesty.
Will work for you, actually, the other way around. But and another key thing is, so going back to Harry Markowitz, he basically coined the phrase of diversification when it comes to, diversification. And the whole idea is to try to spread your risk by investing in many different baskets. And the whole idea is, rather than trying to invest in just one market or in one sector, invest in many different markets, many different sectors, because the aggregate returns of all the different sectors that you see here will net you positive in the long term. Now, as I said, it's very difficult to try to do this yourself, but thankfully there is a solution. And that solution in itself is something called a exchange traded fund, or ETF for short, okay? And in a nutshell, very simply, an ETF is just literally a basket of securities. You'll have your stocks in there. You'll have your bonds. You'll have your REIT. You'll have your gold. You'll have many different types of assets within that one particular fund. What it does is it allows you to buy fractional shares across many different industries, many different companies, and hundreds, if not thousands of different companies, all through one product. So you don't have to do the homework, you don't have to do the research, you don't have to do your own asset allocation work. And as per your bandwidth, you're able to invest into many different markets through an ETF because they allow you to purchase on a fractional basis. Okay. To give you an illustration of this, for example, there's two particular ETFs highlighted on this presentation that we use here at Sarwa. In the case of VTI, it's provided by Vanguard, and its core focus of this particular ETF is to invest in the US market. Now, it doesn't just focus on the top 500 companies. So, there's a lot of popular ETFs that focus on the top 500, most of which are large cap. The S&P 500 is what I'm talking about. But in this case, it evenly distributes it amongst 4,085 companies in the US. And you will have great exposure to all the major industries in the US. So if you're thinking about investing in healthcare, guess what? VTI already has that. If you're thinking about investing in technology, it's about a 27% exposure within that fund to technology. If you're thinking about, banking, for example, that's within the financial section. If you're talking about telecommunications, oil and gas, utilities, it's all there. It's a representation of the entirety of the US market. And we can take it a little bit further. Another example, you've got IEFA, Developed Market ETF, provided by BlackRock. Here, you've got a core focus on geographic exposure, many different industries as well, but the core focus is investing in many different countries. So here you've got Japan, UK, Switzerland, France, Germany, Australia. Can you imagine putting in the effort and work and research that you have to do if you wanted to diversify yourself and invest in those different markets? It's a part-time job in itself, if not a full-time job, if you really want to focus on it, right? But an ETF takes care of this job for you, okay? Anything else you want to add on this one, Daryl?
No, I think you've covered it well and truly. If you guys want any more information on the breakdown of our funds, then reach out and we can disclose those to you. Eamon, just worth noting that we have a good number of questions coming in. So we want to make sure that we can address those towards the end.
Absolutely. What I'll do is so this presentation is going to be available online and through our YouTube channels, on our socials. We'll make sure to send it out to you afterwards. And on top of that, we also have previous presentations on there. But I do want to kind of, make sure that we leave enough room for the questions. So let's start with just highlighting on a high level. There's passive investment strategy, and then there's active investment strategy. We at Sarwa utilize a passive investment strategy, which is focused on spreading the risk while preserving returns, where it's done by buying, holding, and rebalancing the right combination of complementary securities. And this makes the investor experience Zen-like. Active trading is really the idea of you trying to identify particular stocks at a low and selling at a high, which is much easier said than actually done. And more often than not, you're relying on research and also just a hunch to see if you've made the right decision when it comes to investing. If you are going to trade, our recommended guide would be to take a core and satellite approach. And what that essentially means is this: have your core portfolio in a diversified, ETF investment portfolio, and allocate a smaller portion, which we dub as satellite, towards active trading. So if you want to take a speculative approach towards your investing, try to limit your overall risk by maybe allocating anywhere about 20% towards active trading, and the remaining 80% into a long-term passively managed investment strategy. There's a lot of talk when it comes to Bitcoin, and there's no question that it's reached a lot of popularity. You do have access to a Bitcoin fund through Sarwa. We do give you the ability to diversify your portfolio even further through a 5% exposure into a Bitcoin fund offered by Grayscale Bitcoin Trust. If you're questioning whether Bitcoin is ideal for you or not, a great methodology that we think would be ideal to go through is, number one, ask yourself if you have any debt. If the answer is yes, address that first. If it's no, go to the next question, which is, do I have an emergency fund set aside? If the answer is yes, spectacular. Let's go to the next question, which is, do I have a diversified portfolio? Yes, I do. Spectacular. Now start maybe considering having exposure of cryptocurrencies to your portfolio. And as a guide, we would recommend try to kind of crawl before you walk and walk before you run, because the volatility in a lot of these cryptocurrencies is quite significant, and it may be worthwhile maybe just brushing up on the material, reading on it, try experience it, and try to set a limit as to how much exposure to have to cryptocurrencies. On that note, Daryl, take the show away from here.
Thank you. And great information provided through those two important rules, the fundamentals to getting started. So looking forward to covering the next two. But from my side, we would like to focus on lowering your costs. This is something we feel very passionate about at Sarwa. We're always speaking about driving down costs, and we've already dropped the ETF fees as well over time. So it's really important as a benchmark to be paying less than 1%, regardless of who you're investing with. So let's get into this a bit more. Why is this important? As I mentioned with the credit card example, high fees will erode your returns. So this is why it's very key to lower your costs. Simple. You'll find as well that different types of investments have different fees associated with them. So it's really important to get to know what you're paying. You might find that, you speak to a provider, you go into their office, it all looks great, they're wearing a lovely suit, shiny shoes, and you're sat across the table from them, and they're going, look, I'm very cheap, my advisory fee is just 0.5%. And you think, amazing. But what they fail to tell you is that outside of their own commission, that there are also layers of charges, often written in the small print. We actually live in one of the highest fee regions in the world as residents of the UAE. So it's something that you need to be very vigilant of, be aware, and steer clear of the shocks. As we can see on this slide, things to look out for will include things like expense ratios, trading costs, entry-exit costs, maybe those who have already been tied up with some investment schemes, if you've been in the region for a long time, may have experienced things like surrender penalties. This is where if you wanted to withdraw early or liquidate before your end of term, you're getting stung with fees sometimes as 50% a portion of the investment cost. So very, very expensive.
Absolutely. Yeah, we covered the collection charges in just a few about 10-15 minutes ago, but just as a reminder, this is where we're talking about the merchant fees that are being passed on to you if you choose to invest using your credit card. So you want to be conscious of that to make sure that, number one, are you paying merchant fees, and number two, how much are they? Because it definitely can eat into your net worth or into your contribution.
Yeah, and you could be paying 2% a month additional just to fund your deposit. It's another crazy charge. So here we're looking at a very simple example. It's hypothetical, but just to demonstrate how these kind of high fees can actually eat into your returns. If we just take a focus on the bar on the left, it's showing you how a $10,000 portfolio would grow, assuming you had zero costs in a perfect world, and earned a 7% annual return and was left to compound in the markets for 30 years. So as we can see, we'd end up with around $76,000 in earnings, and that's just off a one-off initial contribution, assuming no future deposits. Now, unfortunately, we do have to pay the provider something for this service. And if we look at the last bar, just to give you an extreme example, this is someone who would be paying around 4.5% per annum in costs. And as I mentioned, UAE residents are one of the highest paying regions. So this is not uncommon. Sometimes we see case studies where it's even higher. And you might be shocked at this, but many people are not aware that they're actually incurring these fees because, again, they're in small print. So what ends up happening is you end up giving away over 50% of your profits, if not more, to that nice smiling advisor, and they'll go away and enjoy some very nice holidays at your expense, I'm sure, when this money should really be lying in your pockets. Now, if we give you, just to really hammer this point home, because this is an extreme example, as I said, between 0 and 4.5%, but it's not always that much of a discrepancy in the fees that we might be paying. You might be comparing two exactly of the same identical portfolios, the same underlying assets, the same types of investment vehicle, but the only difference is the fees. One might be 1% and another might be 2%, and you sit there, you discuss with your spouse and think, 1% can't make that much of a difference. But what happens when we apply the effect of compounding? So this was something that Eamon touched upon earlier on in the presentation when we're discussing profits and the importance of starting early and how that can really be significant in terms of your future growth compared to taking profits early on. The exact same thing happens with fees. So that 1% at the beginning might not be so noticeable, but you compound that forward 5 years, 10 years, 30 years. If you're working towards retirement, then that 1% can actually end up paying $300,000 in additional costs just for that advice. And I'm sure all of us, if we said, do you know what, this is going to cost you 300K more, do you want to go ahead? We're all going to say, hell no, switch me to the other plan.
I mean, the coffee is good, but it's not that great at the office. I mean, so I'm not going to charge you $300,000 for advice. So yeah.
Yeah, so really short and sweet rule there. I don't think we need to spend much more time on it, but as I mentioned, 1% should be your benchmark, and really speak to the provider and ask for a complete breakdown of their costs before you sign anything. Now, this is actually one of my favorite rules of the presentation, because I think all of us are likely to become susceptible of our emotions, whether it's applicable to our finances or personal life. Sometimes they get the better of us. So when it comes to investing, it's super, super key not to let your emotions cloud your judgment and influence your decision-making, as it can be so detrimental to your long-term earnings and financial goals. So here we've got a quote from Peter Lynch. He's actually a very famous hedge fund manager in the US, and he was quoted to say that more money has been lost in the markets trying to anticipate corrections than what's lost in the corrections themselves. So what we mean by this is, people who are trying to time the market and predict exactly what's going to happen next are often incorrect. Maybe they panic, they get fearful, and they sell when the markets are low, which is the opposite to what they should be doing, which we'll come to a bit later. And they end up earning less, significantly less than what the average market returns is. So this is just a very quick example of a case study that was conducted by Morningstar. You can check it out yourself if you Google Mind the Gap, the study is called, on Google. It will give you far more information on this, but we just wanted to highlight sort of the key outcome. What this was doing is taking a study of the S&P, I believe it was, through the years 2007 through 2017, so a 10-year time frame. And of course, this does include the 2008 financial crisis. So we're all familiar, I'm sure, with what happened. It's still stuck in our memory from that time, but it was one of the worst market crashes that we had seen prior to early 2020 in over a decade. So global equity markets, they actually dropped around 50% from their peak. And we found that despite this market movement, the fund was still positive overall, with returns of just under 4%. However, because investors are letting their emotions get the better of them, resulting in poor timing decisions, many of them experienced losses of over 15%, simply because they did not stay the course and their emotions took over.
Their investments did better than the investors, really, in a nutshell, is what you're saying. So if he just left it alone, they would have done fine. But people panicked and they sold.
If they had stuck to their plan, so people often, they start investing, they're very optimistic, and they say, I'm going to invest $1,000 a month or $500 a month, whatever it is, regardless of what the market is doing, because I want to work towards my kids' education or my retirement or my car purchase, whatever it is. But then all of that goes out of the window, that initial strong plan that they had in mind, when markets start to take a dive, which they will inherently, because markets are volatile, and that's what they should expect. If they'd stuck to that plan, ride the wave and let the market recover, they would have been in the positive. They would have been just fine.
Understood. I've noticed that there's a couple of people raising their hands. We are going to be approaching the Q&A section very shortly, so feel free to write in your questions and we will be addressing them very shortly.
Yes, so last couple of slides from me. I love this slide. I must say it's my favorite one, well, one of two maybe, but we all invest based on emotion. Greed or fear are the main drivers and the main reason why people tend to buy when markets are high at the top and sell when markets are low at the bottom. As I mentioned, this is the exact opposite to what we should be doing when investing, and it's what happens when we experience optimism and excitement as investments rise. Maybe we're hearing from our colleagues that something's performing very well. Tesla was a very hot topic not too long ago, and you're stood by the water calling, now's a great time to buy. I've made 10%, 20% gains in 2 weeks, and you buy in as things are going higher and higher and higher. So you end up entering the market at the point of maximum financial risk, and we're tempted to buy more. Then markets fall, we start questioning our decisions, thinking, oh, is this the right thing to do? You enter into this sense of denial, maybe even fear, and then it goes into full-blown panic mode if markets continue to drop. So our expectations plummet along with the market. Guys, buying stocks is no different to buying anything else. I'm sure that when we go clothes shopping or food shopping, we spend some time in the aisles looking for a discount and a bargain. We want to buy things when they're on sale, ideally. So you won't walk into a sale, see all of your favorite items discounted and think, do you know what? I'm not going to buy today. I'd rather wait until they're back to full price or maybe even higher. The same logic applies to investing. You want to buy low and sell high in a perfect world. Of course, this is easier said than done. Market volatility can be daunting, and we are constantly surrounded by people telling us to do one thing or another, whether it's our family, friends, or market pundits, news articles. whatever. We're always hearing about the pending doom. It's never positive. So as we'll see on the next slide, we want to really encourage you to block out the noise, because there's always going to be something pushing the markets in one direction or another. So really try and focus on why you started this journey, focus on your financial goals, have a firm investment strategy in place that is going to help you to reach that target, and try and let everything else go that's happening in the short term, because I promise you, whatever is happening today, next week or next month, you're not even going to remember by the time you need that money.
Sound pretty fired up about this, Daryl. Pretty excited about this idea.
I told you, my favorite rule, and it's something like I address every single call I have with clients, because it's just at the forefront of their mind. It's even if you're existing investors, we still have that question. So it's really important to speak to us, which is one of the things that you can do to help control your emotions. Speak to your advisor, get that peace of mind that things are actually okay, and that the performance or the market volatility is normal. There's nothing extraordinary happening out there. Block out the noise, take a deep breath, and don't panic, because it's so easy to act suddenly, irrationally, and then you'll look back and regret that decision 99% of the time. Also, stop checking. It doesn't matter what's happening every day. You don't need to log in and the first thing you do every day is check the stocks. If you don't need this money for 3 years, 5 years, 10 years or more, who cares? Let it go. Ride the waves.
Well said. Well said. I think we're kind of approaching towards the end now as far as what should we be doing. I think as a really good summary of what we discussed today would be, number one, just participate, start, be in the market itself, take a diversified approach towards investing. Don't put all of your eggs in one basket. Manage your investment expenses. Keep an eye on it, much like you would be paying attention to your SMSs whenever you use your card. Pay attention to your investment statements in your portfolio as well too, and try to take a more, I would say, analytical approach towards investing. Make it goal-oriented. Think long-term, patience versus letting your emotions dictate what direction you should be taking when it comes to your investments, because unfortunately it's human nature. We've all been there before, and we will go on an emotional roller coaster if we don't keep an eye out on it. And what we do here at Starwood, just to kind of help our clients with these same principles that we just talked about, is the idea of starting early. We make it very easy for you to be able to open an investment account with us, whether it be a trading platform you're interested in opening, so to take a DIY approach, or meaning you want to be behind the driver's seat and pick and choose your own investments, or if you want an advisory service in which we will give you a recommendation on the ideal portfolio you should take, and we will manage it for you from end to end. All of this can be done in as quick as 15 minutes, sitting on your couch, dining table, in the office, out at the park. All you need is a phone, and you can download the app and you can take care of it that way. Or if you prefer sitting on a laptop or a desktop, you can do it that way as well. The entire journey is digital. Secondly, when it comes to diversification, we will take the time to understand your goals, your aspiration. We want to know as far as your appetite for risk, and we will give you a recommendation, which will be a diversified portfolio of ETFs to help you grow your portfolio. Thirdly, when it comes to managing your expenses, we have 4 different tiers of service, or tiers of pricing plan tiers at Sarwa. If you're just starting out, you just wanted to see if this is the right approach for you, and you want to just maybe do it free of fees, well, you can. We have a starter package. If you're investing less than $2,500 US, we don't charge you any management fees at all for the first year. The moment that you pass $2,500 or you pass the 1-year mark, that's when it becomes a standard account. And at that point in time, we charge 0.85% per annum. Cheapest chips, and actually works out to be, just if it was on a $10,000 investment, you're looking at about $7.41 per month to reach $85 by the end of the year, which is really cost-effective way to invest. If you pass the $50,000 threshold, we start providing you further discounts. So instead of being 0.85, it becomes 0.7. And if you pass the $100,000 threshold, this is where you receive the most aggressive pricing point or pricing plan, and it becomes 0.50% per annum. This is an all-inclusive service. We will take care of your onboarding. We will take care of your rebalancing. We will take care of your dividend reinvestment. There's no exit penalties, there's no exit fees, there's no entry fees. It's a completely flexible solution that's available to you at your fingertips, and we will manage everything for you. The only fee to take into consideration external to this would be the expense ratios for the ETFs themselves, which are very, very low. And more often than not, they're averaging around 0.06%. It's not even something you'd even notice altogether, but they're much more cost effective. This is a very cost effective method of investing itself. And lastly, although we are a wealth management wealth management solution provider, through digital means, you can never replace the human touch. So at any point in time, if you want to reach out to one of our advisors, we've got a team of associates and advisors who could be able to help you and assist you and guide you through your questions, whether it be during onboarding or whether it be during your relationship here with Sarwa. If it's really more just day-to-day questions, we also have a very well-versed customer support team that's available from 9 a.m. till 1 a.m. I don't know if you need to reach out to anybody at 2 a.m., but we'll be sleeping by then. But it's 9 a.m. to 1 a.m. You have access to WhatsApp, chat, email us, call us, whatever your preferred method of communication. Phone lines are, open from 9 to 5, and then the chat function still continues to be open well into the evening hours. And on that note, the last little bit, just as far as the Starwood Trade App, in case anybody is curious, it features zero commission trading. So you can buy and sell stocks and ETFs, in the US for free. So there's no purchasing cost. This is where you have the ability to, take control and pick your own investments to choose. You can purchase on a fractional basis. So it means that if you see a stock is worth, the value of the stock to buy is $100, you don't necessarily need $100 to buy that one share. You can actually purchase a stock on a fractional basis. So if you have $10, you can buy actually, 0.1 of that, of that share, 10% of that share itself. There's no account minimums. You can start for as little as $1. You have access to over 4,000 stocks and ETFs. And on top of that, you can transfer into the account free of charge. We take care of the telegraphic transfer for you. We do the conversion from dirham to dollar at a rate of 3.6796, which is arguably one of the most competitive within the region. So it's all thumbs up, for everybody who's been using it so far. So feel free to try it out. And I think at that point in time, I think it's a good time to start taking some questions, Daryl.
Yes, let's get into some questions because we've got some really interesting ones this evening. And thank you so much for posting them in the Q&A and the chat. So we're going to be starting with some in the Q&A at the beginning, and then we'll try and get through as many as we can. Ayman, have you got them open in front of you? I'm just going to answer one that was addressed early on from Shuja, I believe. Sorry if I mispronounced that, but they're asking, is this process a slow one or rapid? So what I am assuming you mean by that is in terms of the gains or the profits. Are we as a provider able to offer rapid gains or slow ones? Would you agree?
I'm not really, I'm thinking maybe the overall strategy, is it quick wins versus long-term wins? Maybe that's what they're referring to, but we'll just take that approach.
Feel free to clarify if you're still with us, but this is what I'm assuming that you mean by that. So to answer your question in this way, Sarwa is all about slow and steady growth. So as we mentioned, ETFs are the only type of investment vehicle that we use here through Sarwa Invest, at least. And we're not here to make overnight significant gains. It's about helping you to grow your wealth over the long term. So whilst this means that if you were lucky enough to experience profits in the shorter term, absolutely you can withdraw them if you wanted to. It's not something we would encourage because due to the compounding effect, you'll be far greater off in the future if you were to leave them to earn interest upon themselves. But yes, the idea is to invest regularly, get into a pattern where you're disciplined with your investments and let it grow in the background for as long as possible. So I hope that answers your question.
There's a question here regarding real estate. Hatesha, thank you so much for that question. Is at what stage of investing should we start investing in real estate? It's a good question. And, I'm arguing to say that I don't think there's any specific time, but I think in our personal opinion, I think real estate is a great asset class to invest into. It's a great tool for diversification. It's a great way also to be able to generate wealth through a lending facility. And what I mean by that is, think of it this way. So in the UAE, for the most part, I think first time buyers of a property are able to basically put 20% down payment. They're able to finance 80% of the property. Well, the interesting thing is, if the market appreciates, you're receiving 100% of that appreciation on the total purchase price of that property itself, whereas you've only actually really put 20% down. So that's a really great way to leverage to be able to purchase an asset. And over the long term, real estate has a lot of benefits because you can leverage it further to be able to buy more real estate. You'll have an income source. It's almost like creating your own bond, really, in a sense. Now, the challenge of real estate, unfortunately, is that the barriers to entry are quite high because 20% is not exactly within the reach for every individual. Some have the ability to be able to buy property outright in cash, but most would typically go down the financing route, but even at 20% would be quite significant. So if rather than sitting on the sideline and waiting to have enough capital to be able to invest in real estate, I would strongly recommend you prioritize a investment plan into capital markets. In fact, you can still invest in real estate through your, for example, Sarwa portfolio, because one of our ETFs has a core focus on real estate investment trust, or REITs. So it's a hard question to say. I think it's quite specific to your current financial circumstance and what capacity you have and level of liquidity you have, Atisha. But do I believe that real estate is a good component to a overall portfolio? Yes, absolutely.
Thanks so much, Eamon. So a couple of questions here from Camilla. Thank you so much. She is asking around the emergency fund. So would Sarwa offer a financial product or service equivalent to what would be an American T-bill or a fixed interest account where one could put their emergency fund? So Camilla, you're asking about short-term liquidity. So really, really great question. And whilst we don't offer an identical product to something like a fixed deposit or a treasury bill, with us, it is possible to open multiple accounts whereby you could invest in something that is largely bonds and very, very conservative. I'm talking about a 90% plus bond allocation overall. So this is the closest that we would have in terms of our current product offering if you did want to invest in something with us that is accessible, very low risk, alongside maybe something more medium or aggressive for a longer term target. This is fully accessible. So as we mentioned, there's no lock-in periods at Sarwa or penalties. You can withdraw anytime directly through the dashboard. You literally submit the request and would sell the necessary positions for you same day, assuming of course it's a trading day, and the money would hit your local account within 3 to 5 business days.
Just one thing I wanted to mention on that one, by the way. So it's just a matter of time, but we are, in our product roadmap, we are looking at providing a solution in which is going to be like a liquid account in which you can have your emergency reserves, but it's not something that's going to be available imminently. It will be something similar to what you were describing, but more or less a money market account. But again, too soon to say, but that is something that we're looking at as providing as a potential solution for your emergency reserves.
Yes, definitely. It's been raised a lot. So we hear your demands and hopefully it'll be coming soon.
There's a question here, is there a plan for funding their Sarwa account via credit cards in the future? So I know we spent quite a bit of time talking about the drawbacks of making payments via credit card. And that is pretty much the status quo where, well, we prefer our clients not incurring a 2 to 3% fee to transfer money to us when there's other mediums that are available to you that are potentially free. So if you're within the UAE, you're able to transfer in dirhams free of charge. Because typically wire transfers or transfers within the UAE are free, and you're able to fund your Sarwa account that way for free. So the challenge is if you utilizing credit card, as a payment form, you end up paying a premium on top of that. Saying that, we're also cognizant of the fact that we have a number of clients, a significant base that are outside of the UAE, and they're looking for a much better solution than a wire transfer that they have to process in order to fund their Sarwa account. So we are looking at solutions, we are interviewing providers, and we're just trying to find a way to bring that margin down. We want to make sure that you are successful from end to end. We don't want you to be stuck with a excessive fee in order to fund your account. So we're just trying to work with different providers to find the most cost-effective solution for you. So do keep keep an eye out. It's a matter of when, not if. I think that's probably the best way I can describe it.
I'm seeing a couple of questions around risk, if you're happy for me to take those.
Sure.
Before I do, sorry, Camilla, you had one other question which I missed, just around Starwood Trade. So you were asking whether we currently offer non-US domiciled ETFs. Currently, you only have access to over 4,000 stocks and ETFs. However, it is still a relatively new product offering that we have. So this is version 1, and you'll see lots of new product features coming very soon. The tech team are prioritizing this to get more features rolled out as quickly as possible. So you'll see things introduced if you're already using it, things like market orders, and there'll be a more subscription-based model for those who want access to more detailed information and reporting. Cryptocurrencies potentially are on the horizon for later this year as well. So yes, stay tuned and hopefully we'll expand very soon. Now, over to the risk questions. So Hatasha, thank you. And also I'm addressing Bianca's question here. They are asking how to decide the risk level when investing and what would be a smart level of risk to take as a beginner. So I think I can answer these as a combination. But when we talk about risk, whether you are an experienced investor or a complete beginner, it really boils down to 2 main elements. The first is very objective. This is things to do with your financial goals and any specific time horizons that you're working with. Ultimately, the longer that you have in the market to invest, the greater risk you can afford to take on, because if there was to be a substantial downturn in the markets, you have the time to recover from that and are not going to be forced to sell out at lower prices because you need that money. So when we talk about time horizon at Sarwa, because we're ultimately designed for the longer term investor, we would classify short term as anything really from 1 to 3, maybe even 5 years at a push. Medium term really from 3 to 7, and then long term 7-10 years onwards. So this is something to keep in mind when we're thinking about our financial goals. This is one aspect. And then secondly is much more subjective. So this is how you feel about market volatility as a person, how comfortable you are with taking risk with your assets and wealth overall. As a beginner, it's always best to go slow and steady with these things rather than go too far in the deep end and then think, oh, actually, maybe I'm not as comfortable with this as I thought. But your Sarwa portfolio is flexible. So you can adjust it throughout your journey. You can increase it, decrease it. Although we don't recommend doing that in reaction to short-term market movement. There's a small caveat there. But yes, so 2 factors: beginner, start slow and steady. I think that's it in a nutshell. Anything to add there, Eamon?
No, I think you've captured it quite succinctly. I just wanted to note, I know it's past 7 o'clock, and I apologize for those who are in the audience, and we promised to be done by 7. We'll extend it for a few more minutes to answer as many questions as possible. We do hope you can still stick with us and stick around and listen in on the questions that are being answered, because I think it's a great learning opportunity. There's one here, question by Muhammad. He said, do you invest in cryptocurrency if you choose halal investments? So just to get a little bit of context, you have the ability to add or remove Bitcoin exposure within your Sarwa Invest portfolios. Now that's available for conventional portfolios and SRI portfolios. However, it is not available in our halal portfolios. And the methodology behind the halal portfolio is that they are Sharia compliant investment solutions. There's a whole methodology to make sure that there's certain industries are not being invested into. There's dividend purification that occurs within the portfolio. And unfortunately, at this point in time, it's still a little bit of a gray area when it comes to cryptocurrency and whether it's Sharia compliant or not. So I think it's just a matter of time where we get a definitive answer, but we opt to kind of err on the side of caution, and it's not available so far when it comes to the halal portfolios. There's a question here from Samirda about what do you guys think of SPY 500 index for long-term investing? Well, here's the interesting thing. I mean, we could have very easily just created a portfolio of just S&P 500, right? Probably the one that most people typically recognize. It's the one that everybody talks about in the news circles, where they do a comparison, say, well, how did the market do? Oh, let's look at the S&P 500. But the reality is it's a very big world out there, and there's many different markets, many different industries altogether. And for you to just focus on one, I would say, jurisdiction of the world to focus and concentrate your investments in, there's a world of opportunities that you're missing out on. And secondly, you're actually increasing your level of risk overall because you're concentrating it to one geographic region. And I don't know how old you are. Maybe this might have been a timeline where maybe you weren't born yet or whatnot. But for example, a very early 2000s. That's a bad example. Of course, we'd be alive by then. But very early 2000s, the US went through a period of time where for a decade, they had underperforming assets. And the top performing asset, or top performing market during that period of time was the emerging markets, where they were in double-digit growth stage during that time period. So it kind of goes to show you that you don't want to just focus on one market or one geographic region or one sector or any one type of asset class. You want to diversify because, hiccups do happen. And you want to make sure that you're not just solely exposed to that market during that period of time, and you want to diversify it out to different ones.
Thank you. Top of the pile, we have an anonymous attendee asking whether we can explain the return types and the difference between the three options in the Sarwa Halal portfolio. So I think you're meaning the difference between the portfolio types that we have, because there are four options: Halal, conventional, SRI, which is socially responsible investments, and crypto. Now, if I just address the returns between them, they're actually virtually identical. So each of the portfolios, regardless of the type or the values or beliefs that you have, all invest in globally diversified assets through ETFs. The only difference with halal versus conventional, for example, is that it will strip out certain companies that are non-compliant with Islamic investment principles. So it will exclude things like gambling firms, pork companies, alcohol companies, and so forth, so that it is fully Sharia compliant. But with that said, you still have exposure to the similar markets in the US, both emerging and developed markets. Instead of real estate, we use gold. That's another difference. And then, of course, we use sukuk rather than traditional bonds as well. But yes, the returns between all types are very similar. One thing to note is halal and SRI products tend to be slightly more expensive, which can have a small impact to the returns. But overall, you should find that they're closely related.
There's a couple of questions. I'm sorry to kind of jump in. I'm just conscious of time there, Daryl. Just a couple of questions with regards to the ability to pick and choose your own stocks versus taking the Sarwa recommendation. And I apologize if I wasn't clear earlier. So we provide two solutions at Sarwa. We have Sarwa Invest, in which we give you a recommendation of a bespoke, ETF portfolio where they're already pre-selected the different market allocations and whatnot that's already pre-chosen. Or you can go down the DIY route through Starwood Trade, and you can pick and choose your whichever stock you're interested in or ETF that you'd be interested in. So if there's something that you're quite passionate about, you're eager to invest in, feel free through Starwood Trade. But if you feel that you want a portfolio that's being managed for you and you want the recommendation of what you should be invested in, that's Sarwa Invest, and they're both available to you. Maybe we can take maybe just two more questions, Daryl, because I'm conscious of the fact that we're well over time now. Yes. There's one here about being a resident, non-resident, and it's like a twofold question. So the question by Anonymous said, can we buy multiple stocks from different companies and forget about it for 2-3 years? What would happen? Well, the hope would be that your portfolio value has gone up in the next 2-3 years. So it'll be a nice little surprise when you open up your app at that point in time. But with regards to, should I be in the UAE to use Sarwa, or can I be in Europe or the USA? How does the tax implications work in this situation? So number one, you're not required to be a UAE resident to qualify for a Sarwa account. We actually onboard non-residents on a daily basis. So anywhere that you may reside in the world, with the exception of US or USA, or any countries that have been identified as being sanctioned, we're not able to onboard individuals who are residing in those places. well, residing in the US or residing in any sanctioned countries. So yes, we can onboard. And also if you should relocate to another part of the world, that's not an issue at all. Anywhere that you go, you can take your Sarwa platform with you. Now, with regards to tax implications, really comes down to where you're moving to, because while we're UAE residents, for most of us here, there's no capital gains tax because there's no income tax. But that might be, not the case should you move to another jurisdiction that has capital gains tax. And at that point in time, you're expected to report it yourself and pay whatever applicable capital gains tax there is applicable in that country. So really at that point in time, you just download your statements, provide it to your tax advisor and say, hey, look, I have these investments offshore in the UAE, et cetera. What should I be paying? You could have that conversation at that point in time. But on this end here, there's no tax implications.
All right, can I take one final one?
Go
and
right
then
ahead.
we'll have to wrap up, and we'll respond maybe through email for those whose questions we haven't answered. So apologies for that. And thank you.
Probably would recommend, come on board. Actually, what I recommend is, come in, have a conversation with our team, whether it be chat or email or WhatsApp, or even book an appointment with an advisor. If we haven't gotten to your questions today, feel free to book an appointment with us. We'd be happy.
That's a better idea. Yes, definitely, because then we can have a more in-depth discussion. But Preston, thank you for your question. He is asking, can we expect a feature that shows the name of stocks invested under, for example, emerging market stocks, and would like to see the names of the stocks? So take a breath. The funds that we use are public at Sarwa. Everything you need to know is available directly on things like iShares or on Vanguard or BlackRock's website directly. The reason that we don't give a full list of the underlying holdings on the Sarwa dashboard is simply from a simplicity perspective. A lot of the people that join Sarwa, we find are quite new or early on in their investment journey. So we don't want to overwhelm them. Although if you're investing in a conventional portfolio, if you hover over the actual ticker name, so the ETF fund, it should give you a snapshot of at least the top 10 or 15 holdings to give you an idea. But we like to give full transparency so that you do know where your money is being held at all times. And we can share the hyperlinks with you as well, Preston. If that's easier for you, just reach out to the team.
Absolutely. I mean, hey, look, it could even, if you go to our FAQ right now, Preston, if you go to FAQ and just type in, our portfolio, for example, you're going to see the links with the hyperlinks there that will take you directly to the Vanguard website, or take you directly to the BlackRock site, which will actually take you even further into the fact sheet, and you'll be able to at least see the top holdings on there. It's very rare that you'll see any fund manager highlight each and every stock that you're invested in, because they extend to the thousands. So as I said, with VTI, for example, you've got over 4,000 companies you're invested in. It will be multiple pages and docs, to be able to share that detail, but it'll typically give you the top holdings. You'll see the top 20%, 30%, even upwards of 50% that's there, just for simplicity perspective. That's why you typically won't see them there. But if you drill down, you'll be able to see it if you're interested.
Amazing.
I'm losing my voice at this point in time, Daryl.
We've still got nearly 30 people with us, Eamon. So thank you so much, you guys, for
really appreciate it, guys.
It's time now for us to go and have some dinner and to switch off. So.
Yeah, I'm about to lose my voice at this point in time. I think it's the most I've talked in a while. Thank you, everyone, for attending, and we definitely encourage you to put an action, or put a plan in place and take action towards your long-term goals. We want you to succeed. If you succeed, we succeed as well. So it's a win-win scenario. Feel free to reach out to us at any point in time. Reach out to our customer support team, or reach out to one of our advisors. We'd be more than happy to give you some guidance and help you kind of get to that stage of putting a plan in place and action. On that note, good night. Thank you, everyone.
Yes, all the best. Take care. Goodbye.